Vaida in this. So I think there is tremendous change. Sorry to be talking, but what I'm saying essentially is that what you today need is a Bretton Woods 2. That's my suggestion.
Very good.
That what you need is, for major countries of the world, India was, when Bretton Woods 1 was assembling, India was a developing country. We were not even independent at that time. It was a colonial power, British, but India was a part of the Bretton Woods thinking. We had representation. We had a global approach to what we need to do. And then you had the sort of the emergence of these 2, 3, 4 international institutions. We went through also I think a substantial period when there was tremendous collaboration between what you might call the industrial world and the developing world or the emerging world. I mean, I don't hear about any development committee or any interim committee or any international monetary fund, and what happens, G20, G10, we all get together and we use a, what you might say, issue a mandate at the end of it that we should look into it and we should collaborate and we should do something, but nothing is being done. You see, and I recall, and I'm sure that you would recall, that all the premises, the orthodoxy, now you have talked in your paper about that the monetary policy orthodoxy, that we have now got a new approach, and the capital account convertibility. I was there in 1997, Nausha, I corrected. The first day I walked into the Reserve Bank of India, and sorry to be sort of, she would know, and the organizer of this conference, the first day there was a big attack. There was an East Asian crisis, big attack on the rupee, and we have to take unorthodox mix, and we were criticized. In 1997, I still remember it so vividly. There was an IMF conference in Hong Kong, was it? And they were trying to adopt capital account convertibility as the central part, just as current account convertibility was introduced in 94. Joseph may recall, he may have been there too. And that capital account convertibility should also be obligatory on all developing countries. Now the same IMF today is talking about that no, capital controls are necessary. India in 1997 introduced that principle, that any money coming in will be fully free to go, but we will not, but what comes in, no short-term borrowing, or rather limited short-term borrowing, no trade credits of the kind in volumes, only long-term capital flows. Similarly, in exchange rate management. Now today, managed exchange rate is a good thing. Everybody is managing. India was, I think, I'm sorry to be talking about India and particularly those kind of crises, but to manage the impact of Asian crisis, we started flexible but managed exchange rate. And there is a, I mean, those who have studied history and so on, the IMF did not, they just said that, this is not correct and so on and so forth. We should either be fully flexible or fully fixed. But managed, flexible is not good. Now the reason why I'm talking at this length is that we are facing a period, the period of, it's not a stagflation, it's not a stagnation, but it's a period of pre-crisis stage in the world economy, and there is no global
governance,
not governance, global rules of the game, as it were. What is it? Sorry to be speaking at such length.
I think actually you answered a lot of questions.
Oh, I have answered your question. That's nice to know.
Ask you.
He was always very polite. Subbarao and worked with me.
We'll come back to many of these questions.
Sorry,
no, not at all. You can,
but I do believe that in this
that's
assembly that we need to think a little, more on the global.
Sure. So what about you? Specifically on the Ujit Patel committee, I saw you scribbling away notes very furiously. So do you think that we should move away from this multiple indicator approach, somewhat discretionary policy objective of the Reserve Bank, to more well-defined, more transparent objective function?
Actually, I assured myself that I will not speak anything about India, and I don't know much about the rest of the world. So I informally assured everybody that I will be as abstract as possible. But the question is two-pointed, therefore I'll strike a balance of being abstract enough but relevant to the extent possible. I think the way I would ask the question is that globally, those who practice the sort of a purist approach, there's nothing like 100%, but relatively purist approach to inflation targeting are having second thoughts. I think that is established. So we should also ask ourselves, should we have second thoughts about what we were doing? So in opposite, or should we move in the opposite direction? I think that's basically the question. We should find an answer for that. What is the reason why we have to be in this area, move away? Second question, and I think that should be articulated. Second question is, what is the purpose of inflation targeting that we are advocating? The way I look at it is, in India, can we sell it to people that government is not responsible for inflation, Reserve Bank is responsible for inflation? Especially when inflation is high, and if you come up with this explanation, the credibility will be a bit problematic. But again, whoever is articulating, he or she has to say that people will be able to buy greater commitment of the government to inflation if the matter is handed over to RBI. I'm not sure whether the people of India are prepared to buy it. We have seen people of India for the last 50 years, they look to government, particularly inflation. Elections are won or lost on inflation more than anything else. Third question is, given the current situation, can the RBI deliver? And if it goes into targeting, if it cannot deliver, there can be erosion of its own credibility. And by and large, I think in India there is a consensus that one of the public institutions highly respected in India is the Reserve Bank of India. I think once you answer these 3 or 4 questions, the answer will be self-evident. Thank you.
Yeah, but I think the debate is more about RBI having too much discretion and not being forthcoming on which objective is taking precedence at any point of time. So what the analysts, what the financial sector, what the nation is demanding is that there be clarity on when growth, for example, takes precedence over price stability, when financial stability takes precedence over growth. Can there be some sort of rules governing this objective function?
I think that's a very valid question, but again, being somewhat old, I'm reminded of a day when Governor of New Zealand, about 15 years ago, came to India to deliver a memorial lecture. And he put all these and more arguments in favor of inflation targeting. One person was presiding over that meeting, Governor Jalan, and he stood up straight away and countered those arguments. I think all we have to do is go back and look at the reasons why inflation targeting was advocated and why at that point of time Governor Jalan felt that will be inappropriate. I'm afraid the fundamental features of Indian economy, or for that matter even global, but Indian economy have not changed. Maybe global wisdom has changed, but it has changed more in the direction of non-inflation targeting, inflation targeting. I mean, all I'm saying is the arguments are not new.
Okay. Now, let me raise a question about the importance of savings rate in monetary policy calibration. That did not come up yesterday. It came up obliquely, but not as explicitly as it should have. Monetary policy, as we all know, is a question of trade-off between growth and inflation, trade-off between the interest of lenders and borrowers, and trade-off between, as Joe Stiglitz said yesterday, between savers on one side and consumers and investors on the other side. But some concerns do not come up in monetary policy calibration. Like Minouche said yesterday, that inflation is a regressive tax, it hurts the poor the most. But when we make monetary policy, the voice of the poor is not heard. What's heard really is what the articulate lobbies in the economy say, the the trade bodies, the financial sector, the industry, the legitimate interest groups. But there is a large interest group that is not heard. But more specifically, I believe the voice of savers is also not heard, not just in India but around the world. Take QE, for example, quantitative easing. That's a tax on today's savers to bail out today's consumers and investors. And Chairman Bernanke admitted as much in one of his speeches. I was reading Alan Greenspan's interview on when he was promoting his recent book, what's it, The Mind and the Territory? The Map and the Territory, The Map and the Territory. And he says there that in his 18.5 years of tenure in the Federal Reserve, he used to receive thousands of letters and notes every year from people asking him to cut rates. But he said, I've not received any letter, any note asking me to raise rates. And that's my experience in the Reserve Bank too. People have shouted from rooftops that the Reserve Bank must cut rates. But nobody ever said that the interest of savers is hurt, you must raise interest rates.